Let's be honest. For years, most of us have been looking at investing all wrong. We're obsessed with the daily swings of the market, playing a game that's built on stress and anxiety. We're glued to our screens, constantly watching our portfolio flicker between green and red, feeling a high when it's up and a pit in our stomach when it's down. But what if there's another way? A method that lets you build a true passive income machine, one that pays you even when the market is tanking. In this video, I'm going to share that exact script with you from start to finish. The old way of investing tells us to buy low, sell high. This strategy is all about the price of our stocks, something called capital gains. The problem? Capital gains are completely out of our control. They're tied to the whims of market sentiment, economic news, and whatever wild events are happening in the world. This focus on price feels a lot like gambling, doesn't it? It creates this constant low-grade panic. When the market drops, it feels like you're losing money in real time. And you start to ask yourself, should I sell now before it gets worse? That thinking is a recipe for stress and almost always a bad decision. You sell at the bottom because you're scared, and then you buy back in at the top when things feel safe again. It's a vicious cycle. What if we could just step off that roller coaster? What if instead of chasing unpredictable prices, we instead focus on something much more stable and predictable? The solution is to flip the script entirely and to stop being spectators and start thinking like business owners. This is the heart of dividend growth investing. This is a strategy where you buy shares in high quality established companies that have a long history of not only paying their shareholders a slice of the profits, but increasing those payments year after year. Think of it like owning a tiny share of a fantastic company. And when that company profits, you as an owner get your cut. That cut is your dividend payment, and it's real cash deposited directly into your brokerage account. Now, this isn't a get-rich-quick scheme. It's a patient, long-term approach to building true wealth. The goal isn't to find some crazy stock that's going to double overnight. The goal is to build a reliable stream of passive income. This is the script for a low-stress financial future. The first and most crucial step is a major mindset shift. You have to stop obsessing over the daily price of your stocks and start obsessing over the income they generate for you. Here's an analogy. Imagine you have a rental property and you have a great tenant that always pays on time. And then this month, some real estate website claims that your house values dropped 5% because of market jitters. Are you going to panic sell your house? Of course not. You care about that rent check showing up every month. The cash flow is what really matters. Dividend investing is the exact same idea. Your portfolio of dividend stocks is your collection of rental properties. The companies are your tenants, and the dividends are your rent checks. When the market has a bad day, your portfolio's value drops. That's just a paper loss. It's the market's opinion. But the dividend income, that's real cash hitting your brokerage account. This shift from worrying about price to focusing on the paycheck is the secret to removing emotion from investing. You no longer have to fear market crashes. In fact, you might start looking forward to them. Okay, so we have the right mindset. That brings us to the biggest debate: individual dividend stocks or dividend-focused exchange-traded funds, or ETFs. Picking individual stocks can be fun, but it's a ton of work and a lot of risk. You'd have to become a part-time analyst, digging through financial statements of 20 to 30 companies just to make sure your dividends are safe. If you pick a loser that cuts its dividend, your income takes a hit, and usually the stock price follows. That's not a low-stress path. For most of us who want passive income without the headache, the answer is dividend-focused ETFs. An ETF is one investment that holds dozens or even hundreds of stocks. When you buy one share of an ETF, you are instantly diversified. The fund follows a set of rules: screening for companies with strong financials and a history of growing dividends. And it periodically rebalances by removing companies that no longer meet the criteria and adding new ones that do. Your job becomes simple. Instead of finding the needle in the haystack, you just buy the haystack. Look for ETFs with a low expense ratio and ones that have a clear focus on dividend growth. Finding an ETF with a starting yield of 2 to 4% And a history of growing that dividend by 8 to 12% per year would be a fantastic opportunity. Though it's important to note that is an aspirational target, not a guaranteed find. It gives you solid income now and a potential for that income to grow much faster than inflation. You've changed your mindset and picked the asset. Now it's time to build your machine and flip on the turbocharger, automatic investments. The best way to start is with dollar cost averaging. This just means investing a fixed amount on a regular schedule, say every week or month, no matter what the market is doing. It stops you from trying to time the market and keeps you consistently buying more income producing assets. But the real magic happens when you turn on the dividend reinvestment plan, or DRIP. Nearly all modern brokerage accounts have this feature. When you enable it, every time you get paid a dividend, that cash is automatically used to buy more shares of the same ETF. This creates a powerful compounding snowball. Let me show you. Imagine you own 100 shares of an ETF that pays you $1 per share per year. In year one, that's $100 in dividends. With dividend reinvestment, that $100 in dividends buys, say, 2 more shares. Now you own 102 shares. That next year, you aren't paid dividends on 100 shares. You're paid dividends on 102 shares. Your income is now $102, which when reinvested buys even more shares. Your shares buy dividends, and those dividends buy more shares. It's a beautiful wealth building cycle. And here's your secret weapon in a market crash. When the market falls, the price of your ETF gets cheaper, and that's a good thing for you. That same $100 in dividends can now buy even more shares at a discount. While everyone's panicking, your dividend reinvestment is scooping up income producing assets on sale. When the market eventually recovers, you'll own significantly more shares, which will permanently increase your dividend income. This is how you turn a crash from a crisis into an opportunity. Now, you might have some questions. A common one is, what if a company inside my ETF cuts its dividends? This is exactly why we choose ETFs. While dividends are never guaranteed, if one company out of 100 in your ETF cuts its dividend, the impact is tiny. The fund's rule-based system will eventually replace a struggling company and replace it with a stronger one. Diversification is your built-in safety net. Another question is, how much money do I need? You can start with just $10. Seriously. The amount you start with isn't nearly as important as your consistency. Start small, automate your investments, and let compounding do the heavy lifting. And that's it. The script for building a low-stress, passive income machine, it's not about flashy charts or risky bets. It's about 3 simple yet powerful steps. First, shift your mindset. Stop chasing price and start focusing on reliable and growing cash flow from dividends. Second, use low-cost, diversified dividend ETFs. This eliminates the stress of stock picking. And third, turn on automatic dividend reinvestment to create a compounding snowball that accelerates over time, especially during down markets. This is how you build a portfolio that pays to be patient. It's how you sleep at night, knowing even if the market is chaotic, your income stream is designed to be secure and growing. You're no longer gambling with the daily odds. You're a business owner patiently collecting your profits. If this low-stress approach makes sense to you, hit that subscribe button. And I've got a question for you. What's your biggest fear about investing? Drop it in the comments below, and let's talk about how this strategy can help.